I've got another real life story that business owners, especially S corporation owners, need to hear. A new client came to me recently with a pretty standard situation. They run an S corporation, they've been in business for a few years, and until now, they were working with a tax preparer. No accounting support, no strategy. And when I reviewed their prior year tax return, I found something that made me say, wait, what? This client purchased a work truck for their business, and instead of depreciating it like an asset like you're supposed to, it was buried right in the cost of goods sold on Form 1125A, as if the truck was a part of their product inventory. They put the truck purchase inside a purchases line in the cost of goods sold, and to make it worse, their ending inventory was reported as zero, so the full amount flowed through as an expense in the current year. And here's why that's a problem. When you buy a work vehicle for your business, it's considered a capital asset. That means it needs to be depreciated over time or expensed properly under Section 179 or bonus depreciation if rules to it apply. It's not something that ever goes into your cost of goods sold unless you're running something like a dealership and you're literally selling trucks. Now remember, capital assets means they have a depreciation schedule. Inventory or cost of goods sold is the cost of resale goods. By putting it into the cost of goods sold, the tax preparer overstated the business expenses. Not only did that lower the taxable income artificially, it also misrepresents the actual performance of the business. And that creates a huge mismatch between the tax return and the business's balance sheet, which lists all of its assets. So what happens if something like this goes unchecked? Well, you could face IRS scrutiny if you're ever audited, you lose track of your business assets on your balance sheet, and if you ever go to sell your business or get some financing for your business, your financials are misleading. And let's be real, if you're showing no ending inventory and you're expensing major purchases in the wrong place, it's going to raise a ton of questions and a bunch of red flags. First, we took the truck out of cost of goods sold and reclassified it properly as a fixed asset. Then we applied the correct depreciation in the year that it was purchased. It was still subject to Schedule 179 depreciation. It just had to be done correctly. We also cleaned up the inventory reporting of the cost of goods sold so it only reflected what it was supposed to, the cost of goods sold. That gave us a more accurate profit picture, and it also ensured that the return was compliant. And this kind of mistake is super common when people rely solely on tax preparers and skip working with an actual accountant. Tax preparation is about reporting what happened. Accounting is making sure everything is recorded correctly, strategically, and in a way that protects your business long term. Now remember, trucks are assets, not inventory. Cost of goods sold is not just a bucket where you dump all of your expenses. Your ending inventory matters, and depreciation is something that you have to keep track of. If you're not sure whether your return is clean or your assets are being handled correctly, get it reviewed. The IRS doesn't care about your excuse of, oh, my tax guy did it. So don't let a misfiled return cost you money or peace of mind. If you've been running an S corporation and just working with a tax preparer, let's change that. Let's make sure your books actually reflect your business. Thanks for watching, and remember, not everything is a cost of goods sold expense.